Welcome to Keep What You Earn, your judgment and jargon free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So, a lot of things that accountants, including myself, take for granted are the weird words that we use and our fundamental understanding of their meaning, like their ABCs, one, two, threes, like we learned them on Sesame Street, right? And for a lot of accountants, it's really common knowledge to understand what certain words mean in the context of business because we speak the language of business. And kind of like if you speak English, which I assume you do if you can listen to this podcast and understand it, it's like explaining like why English is structured the way it is. Like why EIGHT is 8, HEIGHT is height, right? Or enough and through and tough and why they are all pronounced that way, right? We can't really explain it. It just is. It just is that way. And I find that accountants have a similar approach to their language and they think, well, I don't know why it is. I just learned it this way when I was younger and it's instilled in me and it's just part of my like genetic breakdown, I guess, right now. It's just that ingrained. And one thing that we don't do enough of as accountants is kind of take a step back, zoom out for a second and go, wait, why is that? And what's the difference? And how do I actually explain this? So a story came across where a client of a friend of mine didn't understand the difference between these two things, which is margin and markup. And I realized that, oh my gosh, yeah, that people need to understand this. People need to understand the difference between these two things because they're sometimes used interchangeably. And we don't know what we don't know as accountants. Like we don't know that there's confusion around that because for us, it's super clear, but for most people, it's not. So I'm going to use today's episode to unpack the difference between these two things and why you need to know them. But first, the why you need to know them, because if you're diving into this episode and you're like, what the hell are these things, Shan? Why do I need to know this? This is super important because this will enable you to have these high level strategic conversations with your CFO or with your team about how you're structuring your pricing, how much money you're making, if it's sustainable, right? If you are actually profitable, and really how much you're keeping of what you earn, which is what we're here for, right? So, so I want to go into an example. Now, I'm not on video. I know you're listening to me on the podcast. So bear with me because I'm going to use some numbers. And if you want to, write this down by all means, but it's going to be very simple. So we're going to sell a widget, whatever that may be, a product or a service. You could just use anything to describe it. The cost of that, the cost being what I have to pay. I'm the business owner. It costs me money to sell this thing, right? So the cost of goods is $150, let's say. $150 it costs me. So I buy a product for 150 and now I have to sell it. So as you're probably thinking, am I going to sell it for the same amount that I bought it for? Absolutely not. No, we don't want to do that. We want to be profitable, right? We want to make money, not just cover our costs. So I'm going to charge for this item $225. Okay? It cost me 150. That would be a $75 markup. So marking up means taking what it costs you to buy something or to provide it and then marking up the price over and above that cost to dictate how much profit you get per sale, right? So markup is how much are you marking it up so that you're profitable? Makes total sense, right? So in this case, if you have a cost of 150, you add 75 to get to the 225, that is what we call a 50% markup because 75 is 50% of the 150 that it costs you. So you're going to take 150 and then add 50% of 150, aka 75. Okay? So a 50% markup is based on the cost. Based on the cost. Now, in this exact same scenario, does that mean that you have a 50% margin on your price? So it doesn't, and I'm going to explain why. Margin is how much you keep of the price that they pay you. Okay. So in this example, again, we have a price now of 225, a price of 225, but it costs us 150, remember? So our markup is $75. Our markup is 50%. Our margin is also $75. However, the margin percentage is $75 divided by the 225 price. So the margin is how much profit you make divided by the sales price. The markup is how much you're adding to the cost, so basically your profit, divided by the cost that you're paying for the item. So you see how these can be definitely confusing, not to mention they sound like each other, right? So you've got markup and then you've got margin. The margin in this example is actually 33% because the margin is $75 divided by 225. Ah, okay. So we have a 33% margin. So when, for example, you're setting goals, you're looking at industry benchmarks, you're looking at standards, and you're seeing that the average margin for your product or service is, say, 35%. That does not mean that you take your costs, add 35%, and magically you have a 35% margin. It does not mean that. That's a markup. That's a markup. Your margin will inherently be lower than your markup in most cases. Your margin will be lower than your markup. So keep that in mind. So make sure that you're actually measuring the right metric. Make sure that you're taking a look at the trends on those metrics and don't interpret those to be the same. Now, I personally think that tracking your margin is basically an essential for any business owner. I think that you should be targeting a certain margin. I think you should be intentional about, hey, I want to be reaching about this margin in my business to make sure you're keeping a percentage of every sale that you make and that you have a set percentage in mind of your target of how much you want to keep. Now, how we figure out what's reasonable, that's great for your CFO. That's something that we do with clients, right? But you can also look at industry standards. You can look at what other people are doing. You can also kind of look at your own trends and behaviors and figure out, hey, I think I want to be hovering at about this. I want to improve my margin by 5%. So if I'm currently at 20%, I want to get to 25% by the end of the year, right? You could just be focused on progress towards a higher margin. You can always do that. But just keep that in mind that simply marking up your price does not one for one translate to margin toward your goal. And make sure that you're tracking that properly to make sure you are measuring and that you are looking at trends over time on those different metrics. I hope this is helpful. Margin versus markup, very different things. Play with this with your own business. Take an example. Look at the price and the cost of what you sell and actually run an example by to see what your margin and what your markup is. And you'll notice that they are different. If you're an entrepreneur who's just starting out, it can be overwhelming to think about all the responsibilities you have when it comes to financial management and taxes. Even if you've been binging this podcast, implementing all of it can be really stressful if you don't have a clear list of action steps and know exactly what you should be doing right now. Luckily, we organized all of this for you in the Business Financial Quick Starter. This is your one-stop shop for beginning steps of entrepreneurship so you can build your business confidently from day one. This is not me teaching accounting, no way. It's a specific set of essential action steps to save you a lot of time, money, and headaches as you embark on your own entrepreneurship journey. We cover everything from setting up your business bank account all the way through avoiding a surprise tax bill. Now, as a podcast listener, you get 10% off with code KEEPWHATYOUEARN, all one word. So dive in now and access your Business Financial Quick Starter. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.